Uh, we shall continue from where we stopped in the last class. And first, I would like somebody to remind me of where had we stopped in the last class on that. I think it was a holiday. When we had that makeup, what were we doing? What were we discussing?
Scenario analysis.
Also, did we start on the last sitting's question on scenario analysis?
Yes.
So how many cases had we done?
Just the base case.
Just the best case, yeah?
Yeah.
I think we shall continue with that and look at the other two cases. You know, apart from the best case, we had the optimistic case, and then we also had the pessimistic case, yeah? So that let's proceed to then look at the second case, possibly the optimistic case. So allow me to, in a minute, find that Excel for the last class. Yeah, somebody has not muted. Somebody has not muted. Yeah, so could somebody confirm that this is where we had stopped in the last class? What we calculated last was the NPV and the internal rate of return for the best case or the expected case, yeah? So you have to remember that in the same manner, yeah? In the same manner, we shall have to compute, or rather we shall have to analyze the second case, Let me start with the optimistic case. Now, so we need to have almost similar workings so that we shall still arrange our work in the same manner. Only that for now, the second case, we shall So under the expected, the initial investment was 100 million. The changes for the other two cases are these percentages. And when you check on under the optimistic case, we have that the initial investment should change by negative 20%, yeah? In simple, what does this mean? That under the optimistic case, the initial investment should be how much? Let me hear from one of you. When the expected was 100 million, and then now the optimistic, we have minus 20%, so a change of minus 20%. How do we get the initial investment for the optimistic case? Yes, somebody? Would I hear from somebody? Minus 20% means that you decrease, yeah? You decrease the expected initial outlay by 20%. That's what minus 20% means. So the expected, we had 100 million, decreasing by minus 20% means we multiply. That is now for the optimistic case, we multiply 100 million by 80%. So if I come back to my optimistic case workings, I'll say that equal to, I will come back up here and pick the 100 million. And then I'll say multiplied by, you know, we are minusing 20%. So multiplied by 80%. Multiplied by 80%. That will therefore give us a figure of minus 80 million, or rather 80 million, so that I need to make it a negative. So before the first cell, before my cell C10, I'll just put minus, so that comes to negative 80 million. Gadungu, can you now confirm that you can hear me? Can you now hear me, Gadungu? All right. So that is therefore how we compute the initial outlay under the optimistic case. So I simply decrease by that 20%, so that I have negative 80 million. Now let's look at the residual value. So under the expected, the residual value was an amount of 20 million. For the optimistic, we are told that the change we expect is then plus 10%. Plus 10% means that we increase the 20 million by 10%. We already saw that the initial outlay apply for year 5, yeah? That's when the project ends. So under year 5, we will say that we have equal to I pick the 20 million under the expected. I multiply by what? Plus 10% means you increase. So I multiply by 110%. Being a cash flow that we shall receive, that one we let to remain a positive. So that will be positive 22 million. All right. The next one is working capital. Now for the working capital, again, we were told that we have the initial. And under the expected, the initial, we have 15 million. Under the optimistic case, the change should be minus 5%. So we decrease by 5%. So I'll come back to my workings again. And under period 0, I will say that equal to, I'll pick the 15 million, but then I will decrease it. So times 95%. So again, before the cell, I will put minus so that I have a negative cash flow, that being an expenditure. What I get is 250,000. We then need to make adjustments for inflation for year 1 to year 5, or rather year 1 to year 4, because we saw that year 5, the initial, or rather the working capital, then reverts. So in year number 1, how much shall we consider? You know, we had agreed under the expected case that the only considerations from year 1 to year 4 are the increments by inflation. So I'll pick the initial outlay for year 0. I will increase it. So I will multiply by how much inflation rate do we have under the optimistic case. When I come back to the question, under the optimistic case, the inflation should be 3%. You know, under the expected case, it was 5%. But then now under the optimistic case, we change that to 3%, so that for year number 1, the increment will be 427,500. When I come to period number 2, I said that I add the initial outlay plus the increment for period 1. And then I multiply this by, again, the inflation rate of 3%. For year 2, I get that. The same thing for year 3. I'll pick the initial inflation plus for year 1 and 2 increments. I multiply that by, again, 3%. And then lastly, year 4, I will pick the initial outlay plus for year 1 to 3, and then that I will multiply again by 3%. Of course, lastly for year 5, we said that those cash flow reverts. so that this will equal the, of course, negative the summation of all that. That means in year 5, reverting means that comes back to a positive, and so that we have positive 16 million 38 500.54. All right. We then proceed to the revenue, and back to the question again. Yeah, the revenue for the expected case was 140 million. Under the optimistic, we should have a change of plus 10%. That means for period 1. That means that for period 1, yeah, revenue shall equal, I pick the 140, I multiply by 110%. Period 1, I will have 154 million shillings. Of course, it was clear that the revenue changes from period 2 to 5 just by the inflation increment. So when I come to period 2, I'll pick revenue for period 1. Then I'll multiply by 1, or for the optimistic case, the rate of inflation is 3%, so times 103%. That will mean period 2, we have 158, now 620. I'm trying to move very quickly because I'm assuming you can remember what we did under the expected case. So we are doing more or less the same thing. Yeah? Only that I am now making changes for the optimistic case. The first expenditure, we had the direct costs, which I'll say equal to, for period number 1, I pick that for the expected 60 million. I multiply by the direct cost should change by negative 20% under the optimistic case. So that means I multiply by 80%. I multiply by 80%. But then again, I want that as a negative. So before the cell, I'll put minus. That will give us minus 48 million. When I come to period number 2, I'll pick for period 1. I will increase it by inflation of 3%. So times 103% period 2. What we get is 49,440. And then I apply the same formula to the last year. So the same thing for the incremental fixed cost, where again for period 1, I pick the expected 40 million, but then I change it by minus 10%. So I multiply by 90%, so that period 1, that's 36 million. But again, to make it a negative before the cell, I put minus. Then when I come to period 2, I take for period 1, I multiply by again 103%. so that I then apply the same formula to the last year. The other two cash flows are the tax on our disposal and the tax on profits we calculate differently. And so, yeah. The first working we need is for the first working I need, yeah. The first working I do, is for the wear and tear allowance, or what we had called the capital. The capital allowance. Now the working for the capital allowance, remember, was this working? The working for the capital allowance was I'm looking for it. I'm looking for what we did under the expected case. So the working for capital allowance was this, yeah? This one here. So what I'll do is to again, what I can actually do is to copy that information. I'll copy this. And copy plus the figures. And copy plus the figures. Remember, they should start from period 1 to period number 5. That way. The only thing I need to change, yeah, remember, is the cost of the asset at start of period 1. They are 100 million, which is this, yeah. They are 100 million, which is that. The one I have in yellow changes when we now come to the optimistic case, yeah. We have seen that under the optimistic case, the 100 million, the initial investment, reduced to just this 80 million, yeah. So I'll change this to 80 million shillings. I'll change that to 80 million shillings. Then capital allowance, we know that should be 80 million multiplied by 30%. That gives us that. And so the carried forward balance will be, allow me to make the capital allowance a negative by putting minus before that cell, so that the carried forward figure is that 80 plus the minus 24. The written down value for period 1 is therefore that 56 million shillings. And so I said at the start of period 2, we should have the carried forward at end of period 1, yeah? Then I said that apply that formula across, that is to the last year. The same thing as the formula for the 24 million for the capital allowance. And then the same thing as the balance carried forward, the 56 million. So you can now see that at end of period 5, the value of the asset now become, yeah, the value of the asset now become 13,455, 600 million shillings. Now, the next cash flow that we wanted to compute is again as a working. The next cash flow that we wanted to compute is the tax on disposal. The tax on disposal, yeah. For us to be able to compute this, remember we had agreed, yeah. For us to be able to compute that, remember we had agreed that the two values which we compare, one is the disposal proceed. One is the disposal proceed, which we compare with asset value, the asset value at the time of disposal. Now the disposal proceed is the scrap value, which under the optimistic case, we already adjusted to this figure, yeah, this 22 million, the same as the residual value. So we adjusted that to 22 million. So compare that with the asset value at the time of disposal. And the asset value at the time of disposal is this, which we have computed as 13, yeah? So that when the two are compared, we end up, because the disposal proceed is more, we end up with a disposal profit. We end up with a disposal profit, which in this respect is 22 million minus the asset value at disposal, the 13. We get the 8.5 million shillings. Now, being a profit, remember we tax it. Being a profit, remember we tax it, so that the tax payable, we then have this 8.5 multiplied by 30%. That is the taxation rate. Tax payable, we then have 2.5 million shillings. That's an outflow at end of year 5 when the asset is sold. If that is the case, I come back to my schedule for the cash flows. Remember, at end of year 5, I'll say that equal to. So tax payable on profit on disposal, so equal to negative this 2.5 million. So negative the 2.5 million shillings. So that's it for the taxation on the profit made upon disposing the asset. The last working become the taxation, the tax on profits, the tax on trading profits for the period, the tax on trading profits for the period. So in this case, what we do is to calculate the normal trading profit, which is sales revenue less the operating expenses, yeah. Again, in this case, what I will do is to copy the revenue, and the expenses which follow it. You know, there were only two operating expenses from this cash flow information. there were only two operating expenses, yeah? That is the direct costs, and then the incremental fixed, now costs, yeah? So what we can do is to copy, yeah? What we can do is to copy the revenue for period 1. And for period 1, we have computed a revenue under the optimistic case. We have computed a revenue of 154 million. So that's what we have. So to very quickly fill the figures, just apply the copying formula to the other two cash flows. Then apply that formula row-wise to the last year, so that automatically you have the figures straight away. Now, we did agree that one more expenditure to then consider is the capital allowance, because normally for taxation, that's an allowed expenditure instead of the depreciation which we have in normal accounting. So I will then say that I'll copy this for period number 1. That's the 24 million computed above. We have computed that already, 24 million. So that I then apply the same copying formula to the last year. Now, if that's the case, then we can compute the trading profit, the trading taxable profit, the trading taxable profit. So the trading taxable profit for the period. And this will be a total of, I simply sum up those figures. So that will be a total of 46 million period 1. And so I will apply the same formula to the last year. So those are there for the trading profits we have made, yeah? For year 1 to year 5, remember we have to tax them. So that the tax payable, period 1 will have the 46 million profits for period 1, multiplied by tax rate, we have 30%. And so what we get is 13.8 million. Then I apply the same formula again across to the last year. If I do that, remember, I now have the tax as a cash flow on the profits to be made per year. So I come back to my cash flow schedule and say that equal to negative 13.8 equal to negative 13.8 for period 1. So remember that that's taxation that we shall pay. So you have to make it a negative cash flow. And then in the same manner, I will have for period number 2 to period number 5. And with that, we have now computed what we had called the relevant cash flow under the optimistic case. Under the optimistic case, period 0 now to period 5. What the question wanted we do, yeah? Not is to compute NPV and also compute the internal rate of return, so that how much are they? So how much are they for now, the optimistic case? So in the case of the NPV, remember we'll type equal to NPV equal to NPV, open bracket, open bracket. So you start with the rate which is the cost of capital. Now this was 15%. That was 15%, comma. I then pick value 1 to the last. Value 1, remember, is the cash flow for period 1. Leave out the initial outlay for period 0. So the cash flow for period 1, because I need all to the last period, then I just extend that to year 5. I close the bracket, I say that plus, now the initial outlay. And the NPV that we get for the optimistic case is the 109.7 million shillings. So that's what we get as NPV for now the optimistic case. Is there any question on that? That far? Is there any question from anyone? Is there any question from anyone? If there is no question, then we can compute the internal rate of return, which is equal to internal rate of return in bracket. Remember, we now pick all the values. So I pick from period 0 all the way to period number 5. Number 5, I close the bracket. The internal rate of return which I get is 55%. That's 55%, yeah. So that's 55%. So that is how the second case, the optimistic case, should then look like. That is how the optimistic case should then look like, yeah. So any question? Again, is there any question? Any question? Yeah, so if there is no question, then I want to give you a few minutes to work out in the same manner, yeah? The last case, that's the pessimistic case. That's the pessimistic case. And so what I'll do is to give you around 10 minutes, possibly, work out the pessimistic case. Just open a new Excel, yeah, and work out just the pessimistic case and send me that to your WhatsApp group, yeah. Just attach it to your WhatsApp group in your name. Just save it in your name and attach in the WhatsApp group, yeah. So 10 minutes, please carry out that exercise. So go ahead to do that, yeah. All right. So 10 minutes, be quick. So Lillian, you want me to share which one? Do you mean the working for the optimistic case? Is that what you mean? All right. So I'm just sharing that to your WhatsApp group right away, yeah? I'm sharing that to your WhatsApp group right away. So work out the last case, work out the pessimistic case before we can proceed. Yeah, so for those just joining us, there is an exercise that the rest are carrying out. So give them a few minutes to finish. Otherwise, when you check your WhatsApp group, I have already sent, yeah? I have already sent the Excel for the question we are currently attempting, yeah? The paper is set in Excel, and so it is pure Excel, yeah? So when you check your WhatsApp group, I have already sent that particular Excel, yeah? So you can be looking at the question, and the first two cases are which we have attempted. That is the expected case, and of course the pessimistic case, yeah? The last case which the rest are working out is what we call the pessimistic case. So we worked out the expected case and the optimistic case. So they are working out uh, the uh, pessimistic case. Yeah, so Tego, that is right. Wait a few minutes so that yeah. So for the rest, remember you are attempting that in an Excel, yeah, whereby save that Excel in your name, then just share it through the WhatsApp group. I want all of you to have that done so that I want you to have that done so that we proceed on, yeah, all of us together. So in the total cost equation, A plus BX, the value of A is defined as the total fixed cost, and then B is defined as the variable cost per unit. Per unit, the value of X is what we do call the activity level, same as what in simple words we can call the number of units. But of course, X is what we do call the independent variable. The independent variable. Of course, independent in the sense that the value of Y, and Y is normally the total cost. This is what we do call the dependent now variable. So that the total cost equation can then be summarized as Y equaling A, remember, plus BX. Remember, plus BX. So that as we then estimate costs based on the two methods which your syllabus require that we look at, our main task shall be to be able to come up with this equation in this form. And if you remember, for us to be able to come up with this equation, concern will be to compute A and B. Concern will be to compute the two values which I have highlighted. Once you have A and B, then you can come up with the equation Y is equal to A plus BX. The high-low approach and the regression analysis approaches shall be concerned about how do you get A and B, so that at the end of the day, we then have the equation Y is equal to now A plus BX. We have come to the point we want to look at, yeah? How then does the high-low approach estimate the value of A and B? And somebody has told me in the chat already that, so Lillian says that highest and lowest values of the fixed and the variable costs. Now, how does the high-low approach work? What the high-low approach or method does, remember, is to pick the highest and lowest values. That's why you have the name high-low. It picks the highest and lowest values of X and Y. So you pick highest and lowest values of X and Y. Based on the highest and lowest values of X and Y, we determine what we can call a change. And a change in this respect is the highest minus the lowest value. So we shall look for a change in X and Y as the highest minus lowest values of X and Y. Based on that change, we can then determine the value of B, and then thereafter, we proceed to compute the value of A. Now, I want us to illustrate this because your exams is concerned about, are you able to do this in Excel? So check your WhatsApp group. I'm sending an Excel shortly, which we shall use to illustrate this. So check your WhatsApp group and download that Excel. So check your WhatsApp group right away. Download that Excel. We shall use that to illustrate the two methods of cost estimation. And in that Excel, what you'll see is what I am sharing on your screen. Yeah, so the illustration reads that consider the following data provided by your CFO about production in the last year. And in this data, we have the month all the way from January to December. We then have quantity in units. In statistics, the quantity is normally X. And then we have production cost, which is normally the Y. Gadungu, you are saying that you can't access which data? Just unmute so that you talk to me so that we are faster. Which data you are saying you cannot access? Gadungu, I've just sent that to your WhatsApp group, yeah? Can you just check again, yeah? Just check again. Oh, sorry, Gadungu, I sent that to the wrong WhatsApp group. Just a minute. Let me just send it to your group. Yeah, sorry for that. Yeah, so I've just sent it to your other WhatsApp group. Yeah, I've just sent that to your other WhatsApp group. Get it from there. Yeah. All right, so access that so that we look at that info. Yeah, so the information again reads that consider the following data provided by your CFO about production in the last year. So we have month, we have quantity, and then we have production cost. Yeah. Now the first illustration will have the required as what? Yeah. Let your required be. Yeah. That estimate cost equation. Cost equation using the high-low method, using the high-low method. So how does the high-low method work? Actually, let's have two requirements. Let that be required number one, or let that be required A, and then we can have required, B. Required A and then required B, that based on the estimation in A above, calculate the cost of, say, 400,000 units. Estimate the costs of say 400,000 units. Now, under the high-low approach, remember, we are concerned about the highest and the lowest value of, I have said, X and Y. And based on the highest and lowest value of X and Y, we determine what we can call change. And I said that change is the highest value, you minus the lowest value. Based on that change in X and Y, we determine B, which based on we then proceed to determine A. So what I'll do is to say that for the solution, I'll say that we have X and Y. We have a column for X, and then we have a column for Y. Now, the two values which I need are one, I need the highest values, and then also I need the lowest or least value. So I need the highest value of X together with the Y that corresponds to it. And X in this information, remember, is the quantity. The highest quantity we have which one here? Somebody. What is the highest quantity? The highest quantity I want to believe is this last one, the 350. The highest quantity is that last one, the 350. And so I'll say equal to that 350 under X. You need the Y that corresponds to it. The production cost that corresponds to it, we have this 36,000. So I say enter. Similarly, we need the least value of X together with the Y that again corresponds to it. The least X, what have we? We have 90. The least X, we have this 90. The Y that corresponds to it, we have 11,000. I have said that based on the highest and the lowest values, what we need is change. And by change, I mean the highest value. Less the lowest, highest minus lowest, now value. So that I can underline this. I can underline that so that change shall be for X 350 minus the 90, that's 260. And then for Y, we compute in the same manner. So change in X is 260. The change in Y, we have 25,000. Now, based on this, we can proceed to compute the value of B. B, we have said, is the variable cost. Remember, per unit. And the value of B is normally the same as what we can also call the slope. If you remember, if this data is plotted on a graph and you fit for whatever you've plotted what we call the line of best fit, the slope for the line that you fit is what used to define B. And when you talk of the slope, which is the same as the gradient also, this is normally computed, yeah? This is normally computed as change in Y, The change in Y, you divide by the change. You divide by the change in X. And this will mean that what we get as the value of B, this equals what? So you'll just have an equal sign and take the change in Y. Change in Y is this 25,000. So you'll take change in Y, you divide by change in X, the 260. The value of B is that figure. That's what we get. So what we get is 96.15. And that's how we compute B. So that, is there any question on that? That should be very straightforward. Any question on that from anyone? Is there any question on that from anyone? There is no question, yeah? If there is no question, then we can estimate A. We can compute the value of A. Now, I'll say that calculating A, in computing A, remember we use calculating A using the value of B B is what we have computed above, this 96 point something. Calculating A using a B and what? Either the highest. B and either the highest or the lowest values of X and Y. So alternatively, you can use the lowest values of X and Y. So in this case, I'll say that A, which is the total fixed cost. This equals how much? Let's agree that this shall equal what? The equation which we apply is y is equal to now A plus what? A plus bx. What I want to compute is the value of A, and making A the subject of this equation or the subject of this formula shall mean that A equals what? Shall mean that A equals y minus what? Bx. So this is what I'll come back here and use in computing the value of A. So that means I'll say equal to, I take y. Remember, I am using the highest values. So I'll take the highest y. The highest y, we have 36,000. I'll say that minus bx. Bx means b times x. So that it will be b, which is 96 times x for the highest values. X for the highest values is this 350. When you press enter, that's the value of A that we get. That's the value of A that we get. So alternatively, you can work with B plus the lowest values. In the very manner, you'll arrive at figures which are almost similar. So that, any question on how we get that? If there's no question, then remember, you can now estimate your cost equation as y equaling now A plus bx. A we have computed 2346. Remember 0.15, we say that plus, we know B is 96.15. Now x shall remain x, and that's the cost equation based on the high-low approach. That's the cost equation based on the high-low approach. Is there any question on that? Yes, anyone? Is there any question on that? Any question, anyone? All right. If there's no question on that, then you know, this is part A of this required, yeah? This is part A, and so I can proceed to required part B. And part B wanted that we do what? Part B said, in part B of our required, we said that based on the estimation in A above, we calculate the cost of 4,000 units. And that's very simple to compute. We are looking for the cost of 400,000 units. Now, how do we get it? You know, it is as simple as putting in this equation which we have formed, yeah? It is as simple as making this x 400,000. Of course, because we have worked with the figures in thousands, you'll not work with 400,000 that way. You'll work with the 400 units so that the figures are in thousands. So that will mean that the cost of 400,000 units equals what? You know, it is 2346.15, which is this. I say that plus 96.15, so plus this, plus that. But then because the 96.15 is per unit, you multiply by the 400,000 units. So you multiply by 400. The cost of producing 400,000 units is therefore this 807.669, and that's it for that required. That's it for that required, yeah. So any question again? Could there be again any question from anyone? Is there any question? So that is how the high-low approach works, yeah? That is how the high-low approach works, and that's it. And that's it. And that's it. Now, what are some of the advantages of this approach? What are some of the advantages? What are some of the disadvantages? Some of the advantages, some of the disadvantages. One advantage, somebody? We can actually just look at one advantage, one disadvantage. Yes, anyone? Somebody, what is one advantage? So, yes, so thank you very much, Gadungu and Tego. You say that Gadungu says it's user-friendly, Tego says it is easy to use. Yeah, so that is one answer, yeah? It's very easy to apply. It's very easy to apply. What is one disadvantage? What is one disadvantage? Yes, somebody? What's one disadvantage? Now, in a very large set of data, like okay, somebody has talked in so Tego says it uses the highest and the lowest values, ignoring other details. Yes, precisely, Tego. It's an approach that is not very accurate. Yeah, it's not very accurate. It's not very accurate, and that is what Lillian also says. So it's not very accurate in terms of you leave out a lot of data when you select just the highest and the lowest values, yeah? So that makes it not as accurate, say, as a method like the regression analysis that considers all data. So that's one of the serious disadvantages of the high-low approach. So it's a very simple method, really. And so I'll say that that is it. That is it. So unless somebody has a question, then I will proceed to regression analysis. Then I'll proceed to regression analysis, yeah? So somebody to remind us of how does the regression approach normally work? How does regression analysis normally estimate costs? Yes, somebody? The regression approach, which is now method number 2 and discussion, the regression approach, regression analysis. The regression analysis approach is what we can call the statistical. We can call it the statistical method. So in other words, it uses what we can call statistics to come up with the cost equation y equaling a plus bx. And the advantage of this approach is that every single data, you use it to estimate cost. Every single data. Like now in this info, we shall not leave out anything. Every single figure, every single data, we shall use it to estimate now cost. The question is, how does the regression analysis then estimate cost? How does it come up with the equation of y? Y is equal to a plus what? A plus bx. Of importance, remember, in coming up with the equation y is equal to a plus bx, we determine a, we determine value of a, and also determine value of b. So the question is, how does regression analysis compute a and b? That's all. In this respect, what I want us to do, is to refer to the December 2022 question paper, the December 2022 exam, and refer to question number 25. We refer to question number 25. So for those who are not in class earlier, very shortly, I'll share that question paper for December 2022. Check your WhatsApp group. So I've just shared that question paper again, so that let's refer to the last question, which is question number 25, Let's refer to question number 25. Yeah, so the question reads that Farmgate Company Limited produces and sells shovels. The company provides the following data for quantities of shovels produced and the related production cost for the calendar year 2021. Now, I want you to realize that the Excel which I sent you guys, the one we've used under the high-low approach, yeah, that data under the high-low approach is the same data that you have in that question. So I got that data from that question. So it's the same one, the question of the data with month, the quantity, and then production cost. So we shall use the same information to now answer this question number 25, yeah? And what are we told in it? When you look at what the question wants in part A, is that determine the variable cost per unit and the total variable cost using regression analysis. And so I want us to answer that part A of that question, so that I'll come here and say that we have part A. This is now using regression analysis. So what we want is now, first of all, correct something in that question. It reads that determine the variable cost per unit and the total variable cost using regression analysis, yeah? It should be determine the variable cost per unit and the total fixed cost, not total variable costs. So under the total fixed cost using regression analysis. So it should be under the total fixed cost, not total variable costs. So under the total fixed cost. So part A, once we compute the variable cost per unit, and the total fixed cost. So the variable cost per unit and the total now fixed cost. Allow me to remind you that the variable cost per unit in our equation is the value of B. Variable cost in our equation, remember, is the value of what? The value of B. Now B is the same as what I had also called, yeah? I had also called the slope. Well, let me start with the gradient or the slope. It is the same as the gradient or the slope of the line of best fit. If you were to plot this data on a graph and then fit an estimation line. So the gradient of that line, the slope, is the value of B or the variable cost per unit. Now, allow me to say this. There are two ways in which we can compute these two variables. There are two ways in which we can compute A and B. And the first way is to compute them directly based on their functions in Excel. There is a function for the slope or the gradient in Excel that works directly. And so for a function, I have always said that you start with an equal sign in a cell. So in a cell, start with an equal sign. Start with an equal sign, and then you'll type what you want to compute. What we want to compute is the slope. So equal sign, then you type slope. So these are function. And I told you guys, or I mentioned earlier, that in Excel we have so many functions. Under financial management, we had looked at what we call the financial functions, where we had items like the net present values and the internal rates of return. So we had functions for them. Under management accounting, we shall be looking at regression functions. And one of the regression functions is this, which we call the slope. So that if you want to compute anything based on a function in Excel, like now we want to compute the slope based on the slope as a regression function, then start with an equal sign, type slope. You'll then have the open bracket. You'll then have the open bracket. Immediately you open the bracket below it, Excel tells you what to do. That in the bracket you pick the non-y's, you pick the values of y, then comma, then pick the non-x's, pick the values of x. So I'll start by picking the values of y, and the values of y include, you know, y is the production cost in this data. So I'll pick the first y is this 18. I want all of them, so I drag to the last one. I drag to the last one. Then I put a comma. Then you pick the values of the x's. I pick x. The first one is 150, but I want all up to the last. I close the bracket. I close the bracket, and then I press enter. And then I press enter. If you press enter, the value of B, that is the figure that that we get. We get 95.17. So that's how very simply, how very directly, based on the function straight away, we can compute the value of B. So is there any question on how we get that? Somebody, is there any question on how we compute that figure? Any question? All right. If there's no question, then we can proceed, yeah, to look at how we get the total fixed cost. And the total fixed cost, we have said, is the value of A. The total fixed cost, we have said, is the value of A. Now in Excel, again, the value of A is a function. And the value of A is what we shall call the intercept. The intercept. In other words, if this data is plotted on a graph, you'll realize that the function for the total cost will not start at 0. It will normally start at a cost above 0. Why? Because the fixed cost can never be a 0. Variable cost can be a 0, but the fixed cost is never a 0. At the point you have the fixed cost, the total cost function normally touches the y-axis of the graph you would plot. The touching of that total cost function on the y-axis is what we call the two intercepting. So the total cost is therefore called, the total fixed cost, sorry, is therefore called an intercept. And what we shall do is, yeah, being a function also, to get it, we shall start with an equal sign. So we shall say that equal to, yeah, equal to, what we want is the intercept. What we want is the intercept. So you type intercept equal to intercept, and then you say open bracket, and then you say open bracket, so and then you say open bracket. Immediately you have the open bracket again. Yeah, Excel tells you what to do. Excel tells you what to do. That is, you compute, or rather you pick the values of y, again pick the values of x. So in the same manner, yeah, I'll pick the values for the production cost, all of them to the last. And then I'll put a comma, I'll pick the values of x, I'll pick the values of x, I'll close the bracket. When you press enter, then immediately you have the value of a as that figure. So that that's how we compute A and B. That's how we compute A and B using regression in Excel. So they are very straight formulae. But of course, like I've said, we have two ways of getting these two values. This is the first way, where for each work with its function straight away. So that is there any question from anyone? Any question? All right, if there's no question, then that is it for the first way in which we compute the two, yeah? I want to then stop there, yeah? So that for the second way, let's start on this in the next class. So that Gadungu, please, as I start the next class next weekend, remind me to first show you the second way of getting these two, yeah? So Gadungu, is that possible, or that is too much work? Gadungu, is that possible? Oh, thank you very much, Gadungu. So please remind me to start with the second way before I proceed to the rest of what that question require, yeah? All right, so thank you very much, ladies and gentlemen. I will be stopping there, yeah? Let's proceed on next weekend from there. In the meantime, the paper is a very difficult one, yeah? Make sure that you are practicing. Make sure that you are practicing, yeah? So in case of queries, talk to me in WhatsApp. Talk to me in your WhatsApp groups, yeah? Otherwise, asanteni sana and enjoy the rest of your weekend. Nice week. See you guys next weekend. Asanteni.